Where you retire could cost you more than a bad stock pick. I ran the exact numbers for a sales VP in New Jersey who pulls in $200,000 a year in retirement income. What I found made me angry on their behalf. By the end of this video, you will see a side-by-side tax comparison that might change the state you retire in. And it could mean the difference between keeping or losing $200,000 of your retirement income. Stay with me, the numbers don't lie. Here's what we're covering today. The exact mechanics of New Jersey's retirement income tax trap, the cliff that catches most successful professionals off guard, and the real 20-year cost and 3-0 tax states worth putting on your list. Let's start with what New Jersey actually does to your retirement income. First of all, New Jersey's top state income tax rate is 10.75%. Of course, that's on top of all the federal taxes that you're going to have to pay. The rate applies to your 401k and your IRA withdrawals because the state treats them as ordinary income, the same as a paycheck. Now here is where it gets complicated. New Jersey does offer retirement income exclusion. For a married couple filed jointly, that exclusion can be as high as $150,000. Not bad. On paper, that sounds like a meaningful break, but there's a catch, one big one, and most successful professionals never see it coming. The exclusion operates like a cliff. The moment your total income from all sources crosses $150,000, the entire exclusion disappears. Not reduced, not phased down gradually, it just goes away. It's a cliff. If you had a strong career in sales or marketing and you built a solid 401k, you're almost certainly going to cross that threshold. 401k withdrawals can push you past $150,000 without even planning to go. The state designed this as a benefit for retirees. For high earners, it functions as a trap. Let's do the math. Take a retired sales VP with $200,000 in annual retirement income, 401k withdrawals, and a side hustle income. That is not an unusual number for someone who had a strong career. Because their income crossed the $150,000 cliff, the state exclusion is gone. The full $200,000 is now exposed to New Jersey's income tax structure. At that level, the effective state income tax bill can run to roughly $10,000 a year. $10,000 every single year. Not from the market, not from bad decisions, just from the state. Over a 20-year retirement horizon, which is realistic for someone retiring at 65, that is more than $200,000 gone to state income tax alone. That is a meaningful portion of your retirement account. And we haven't even touched property taxes yet. New Jersey's median property tax is over $9,300 a year, the highest in the country, of course. And add that to the income tax number, and you are looking at nearly $20,000 a year leaving your account before you spend $1 on anything you can enjoy. So I was working with a couple last year, both in their early 60s, both former sales professionals at different companies with combined retirement savings of over $1.8 million. They had done everything right during the accumulation phase, but no one ever walked them through what New Jersey was going to do to their withdrawals. When we ran the numbers, they had $200,000 in preventable state taxes staring at them over a 20-year projection. That was the moment they started seriously looking at alternatives. So most people don't realize this is happening until it's too late to change course. You spend your entire career tracking your commission checks. The state is tracking something else, your retirement account, and they're waiting. Before we get into the solution, a quick note. If you are within 5 years of retirement and you live in a high-tax state like New Jersey and New York and California, Illinois, and you have not run a specific state tax projection for your retirement income, you owe it to yourself to do that before you file a single withdrawal in retirement. We offer a free review of your 401k choices. No pitch, no pressure. Our team looks at your actual situation and shows you where the gaps are. The link is in the description and pinned comment. If you're serious about protecting what you've already built, that's the place to start. Now, what do you actually do about this problem? The math for an alternative is straightforward. Florida has no state income tax. Texas has no state income tax. Tennessee has no state income tax. For a retiree with $200,000 in annual income, your 401k or IRA, moving to any one of those states means that income tax bill drops to zero. That is not a projection. That is not a forecast. That is the current tax code. Zero state income tax on 401k withdrawals, on IRA distributions, on Social Security. Over 20 years at $10,000 per year saved, that's $200,000 staying in your account. That number alone can fund years of additional retirement spending or pass on to your next generation. But here's what people get wrong. You cannot just buy a beach house in Florida and call yourself a Florida resident. High-tax states like New Jersey and New York run aggressive audits on people who claim to have relocated. The state has a financial incentive, obviously, to prove you never really left. A defensible domicile change requires a real audit trail. Voter registration, bank accounts, physicians, church or social memberships, the physical location where you spend the majority of your time. The state will look at all of it. This is a legal, well-established strategy. Thousands of retirees execute it every year. The key word is execute, not assume. So what does a real relocation plan look like? 3 components. First, the domicile audit trail. Before you file any change of address, document everything. Where your doctors are, where your bank accounts are now, where your social and professional life is rooted. Then start the deliberate transfer to the new state. New physician, new accounts, new voter registration, and keep records of all of it. The audit trail is your defense. Second, tax bracket management. When you relocate, you have an opportunity to restructure how you take your income. If you move before you start Social Security or before required minimum distributions kick in, you can sequence your withdrawals to stay in lower tax brackets in the new state or at the federal level. This is where the real planning lives. What we did for a client last year was map a 3-year transition timeline. They were 62 at the time we started. They were still in New Jersey, not yet retired, but we built the domicile trail, coordinated the home sale, timed the first 401k withdrawal to occur after their Florida residency was established, and set up a Roth conversion ladder during the gap years before Social Security. That is, in the years of retirement, but before Social Security, when your income is decidedly lower, so your income brackets are lower, so we can convert your 401k or your IRA into a Roth IRA and pay less tax, all combined. So the combined tax savings over their first 10 years of retirement projected to over $180,000. That's just 10 years. Now, the third thing what you need to do is consolidate your 401k accounts before you move. The scattered 401k plans from old employers create administrative friction and make tax planning harder. Rolling them into a single IRA before relocation gives you a cleaner control over your withdrawal sequencing from day one. The 5 years before retirement is the window. After you retire and start withdrawing, your options narrow. The window to restructure domicile, accounts, income timing is before that first check clears. If this opened your eyes to the state tax side of retirement, you're going to want to see this one next. It covers the number one 401k mistake I see professionals making at 55, and it compounds every year you wait. The link is on the screen right now.